Congratulations on the 50th anniversary. It's quite a milestone. Now, 50 years ago, to remind everybody, you suggested that what the average investor needed was a low-cost index fund that tracked the overall market like the S&P 500. You got what you wanted, Bert. So tell us, 50 years later, is the evidence stronger or weaker for index funds as the way to go?
Bob, I believe even more strongly today than I did 50 years ago that it's the way to go. You know, every year, Standard & Poor's does a report. It's called their SPIVA report. It's the Standard & Poor's indices versus active managers. And every year, like clockwork, 2/3 of the active managers are beaten by the index, and the 1/3 who win one year aren't the same as the 1/3 who win in the next year. And so when you compound this over 10 or 20 years, you find that 90% of active managers are outperformed by the index. Now, I'm not saying it's impossible to outperform, but it's like looking for a needle in the haystack. And if you try to go active, the odds are overwhelming that you will do worse than average rather than better than average. And just to put one other statistic from the SPIVA report out, on average, the active manager underperforms the index by about 100 basis points, by almost 100 basis points. And as you know now, with exchange-traded funds, you can get a broad-based index for an expense ratio that's very, very close to zero.
You know, you famously said, and the title of the book is A Random Walk Down Wall Street. What do you mean by a random walk? People often ask me that. The stocks exhibit a random walk pattern. What exactly does that mean, and what's the conclusion about that?
Well, essentially what it means is, while there is some momentum in the stock market, and we always hear about that, particularly from the technicians, it's not dependable enough to make money consistently. And in fact, the development of prices from day to day and from week to week are very close to what the statistician would call absolutely random, like a set of random numbers. And so the effect of this is to say a random walk market is essentially an unpredictable market.
Bert, it's Kelly, and maybe you
have
could...
a famous...
Sorry about that. I was just going to ask kind of I just wanted to know, Bert, what you would make of the current stock market landscape. You know, we've been through this tremendous COVID, very unprecedented time. You know better than anybody all these market cycles we've been through. What do you think of where markets are today?
I think markets are still relatively expensive. And the metric that I use, which is not a metric that's going to predict short-term changes. I'm still the random walker. Nobody can predict the short-term changes. But what does the best metric to predict long-run changes, long-run returns, is the so-called CAPE ratio. In other words, the cyclically adjusted price-earnings multiple. Not the multiple on 2020 earnings, not the multiple on expected 2023 earnings, but rather the multiple on the average earnings over the last decade, what the old Graham and Dodd book would have called earning power. And that metric is well above average. And what it suggests to me is not for the next year or 2 years, I can't do that, but it suggests that returns over the next decade are less likely to be the 9 or 10% historical returns over the last 100 years, but much more in perhaps the 5 to 6% range.